Hi there. So on Friday, Kwasi Kwarteng read out his mini budget thing. This video is a short video, probably not, to go through the document and discuss all the relevant changes. Right. So I'm going to tackle this. There's four headings I think we need to discuss. The first is tax. So what's actually happening with tax? Who's going to benefit? The second I'd like to talk about is, and it's my mic, so I can do it, talk about what I like, is pensions, because there are some changes to pensions, but not that will affect individuals, but that will affect larger institutional schemes. And, well, they will have a knock-on effect on individuals. Yeah. The third thing I want to talk about is what might happen in the economy. And there's a bit of talk about bankers' bonuses, and I think that's been introduced for a few reasons that perhaps aren't necessarily just to allow bankers to pay themselves more. But we'll move on to that. And then the final thing I want to talk about is the markets and the market reaction. I say the final thing. I'm going to talk about that to begin with, and then we'll return to that after we've discussed everything. So I'll just show you the headlines to begin with, and then we'll move on to why. After we've talked about the changes, we can then sort of look at what has changed. And the final thing I probably should talk about is what you should be doing with your portfolios, or what you might want to be thinking about anyway. Obviously, I'm not presenting any advice. I just knocked the mic, which is terribly unprofessional of me. Okay, so let's have a look at some screens. I've got to remember that my picture's in the bottom right of the screen here. Right. So portfolios in general have pretty much not collapsed, but taken a significant downwards turn over the last month. And this isn't just because of the mini, but okay, it's not a mini budget. It's not even a budget, so it escapes all the normal scrutiny that a budget would have to go through. It is in fact this thing. It's the growth plan. So it's a plan for growth. It's not a budget, which is a bit weird to begin with. If we look at Forex, the pound has fallen 3.5% against the dollar. This is still on Friday, obviously. Markets aren't open over the weekend. So this is essentially Friday's data. That's not good. I mean, the pound, I'll just show you, but this is the lowest it's ever been. Let's go back all. So here we go, 1985, it was down to $1 and, 5.5 cents, $1.06. It's now $8 cents. So it's not the lowest it's ever been, but it almost is the lowest it's ever been. The difference being that in 1985, the problem was that the dollar was incredibly strong against all currencies across the world. And in fact, the Fed at the time arranged a meeting between themselves and a load of other economies to essentially allow them to devalue the dollar because all their businesses were having trouble exporting. So that's not the case here. It's just the pound has fallen. See, if we go down to the pound section, it's fallen 3.5% against the dollar, 2% against the Australian dollar. Obviously, there'll be some like currency corrections amongst all these different stocks, but all these different foreign currencies. Some of them, the pound. I mean, that's a bit misleading because the ruble isn't traded, so I don't really know how they've even got stats for that. But anyway, against global currencies, it seems to have fallen somewhere between 2 to 3.5%, and that's so the pound has just fallen in value. It's not that it's weak just against the dollar. I've heard that on a few news outlets. I've heard some politicians saying that the dollar's particularly strong at the moment, and that's why it's not the dollar, it's the pound has fallen. Okay, so just to clear that, that's not a good reaction. Then, if we look at, for instance, indices, so we look at the GB. So this is the FTSE 100. That's fallen 2%. The really frustrating thing is that all markets have fallen over the last week and on Friday. So I don't know how much that 2% fall is because of a reaction to the budget and how much of it is just a general sell-off of markets. There just seems to be a general sell-off of equities at the moment, of stocks and shares. So that's I don't know how much of that's global. But anyway, that's kind of a bit of a summary of what's going on in the markets. So let's talk about tax. So let's go back to the growth plan 2022. So the first thing I wanted to talk about, really, because I think this is quite interesting, is that landlords are set to benefit quite significantly, and I think from two items in it. I've written down in my notes here 4.24 and 4.26, and they're quite close together in the document. And where is it? 4.24. Here we go. So that stamp duty land tax is sort of going down. So if you're buying a property, a residential property, previously you didn't have to pay stamp duty land tax from 125,000. Okay. Up to 125,000. Now they're increasing that nil rate to 250,000. Okay, they're increasing the rate on first-time buyers as well, the threshold. So that's good, but not very many first-time buyers are buying properties of these sorts of values anyway. That really only applies to first-time buyers in London and the southeast. Most places in the country have very affordable properties for, well below 300 grand. My own house, for instance, I mean, I live in Boston, in Lincolnshire, so it's quite a cheap place to live. And I've got a 5-bed semi, and I think we paid 165 for it. It's probably worth 200. It was a bit of a wreck when we got it, but it's probably worth 220, 230 at the moment. So, you can get really nice properties around the country. Boston's not the only cheap place in the UK where you can get a really nice house for much less than the 300,000. So that's not necessarily not necessarily a massive benefit to first-time buyers. However, your buy-to-let property market, 250,000. That's a pretty big saving for people who are buying second homes. They've not mentioned. So the other thing is that people who buy to lets, they have to pay this additional stamp duty on a second property. The second, second home stamp duty. Let's just have a quick. I should have got this up already. 5% above £250,000. Okay, fine. So essentially, those people who are buying, so they have increased, because I think that was 5% above 125,000. So they've increased that as well. So essentially, they're removing stamp duty from the vast majority of property portfolios. I've also made a note to have a look at 4.26, because I think this kind of feeds into the same thing. Increasing incentives for the public sector to sell surplus land. So the public estate owns a huge amount of land around the country. So my own local authority, for instance, own a farm. If government departments are to sell property, including sites for housing, then they get to keep a percentage of the sale, but they don't get to keep the entire money. They're talking about increasing the percentage to incentivise government departments to sell the land. I don't think this applies to local authorities, but this for government departments. Now, there's something here which I'm not sure what this means in practice and what the implication is. But it is a bit worrying that the NHS will be given full flexibility to carry forwards 100% of the proceeds from land sales into future years. Now, does that mean that they're incentivizing hospital trusts to sell off stuff like car parks to private providers, and maybe the units that they're closing down through lack of funding will sell off those properties because we can keep all that money for future? That to me seems a bit of a, that's not ideal, because the departments that are closing within the NHS are not through lack of demand, they're almost always through lack of funding, leading to a lack of demand because there's a lack of supply. So if you've got a unit with very few doctors in it, there's not going to be a massive demand that can be satisfied by that service. So the stats that the NHS publish make it look like they're not being well utilised, and that's not particularly necessarily reflective of what's actually going on in the unit. But anyway, so that's the interesting thing about tax. I think this is really going to help landlords quite a lot, and I think the calculation there is that landlords are generally conservative voters, so they're helping their voters, and I think they're doing that quite a lot. This is quite consistent throughout this document. It's quite an interesting document, actually. I'd encourage you to go and find it. There's a load of infrastructure projects. So wherever you're living in the UK, these are basically going to get accelerated and get done. Now, Boston has wanted a bypass for ages, so I did read through the list, and nope, we didn't get one. No, there's not a lot, but there's quite a lot of projects that they're wanting to accelerate, including Freeport. Which is interesting. I don't really know the implication of that, but it's an interesting mention in here. So there's a load of infrastructure projects. They were also talking about these investment zones. Now, historically, there were these things in the UK called charter cities, which is where a city was given a royal charter, and essentially the local authority were basically allowed to run the city. Boston was one of these cities that got given a royal charter, and essentially the local nobles were allowed to essentially tax the local population and run the local area in whatever way they wanted. And they had to pay a small amount of money over to the Crown for that privilege. Now, these investment zones are kind of similar in that, more or less, they're sort of opting a local area out of tax to the state. So they've got a few ideas here. So these are examples of illustrative sites. So they're not necessarily going to happen, but you've got stuff like the Charnwood campus in Leicester, Gravity in Somerset. So these are potential investment zones where essentially employers won't have to pay as much national insurance. In fact, it's quite reduced. There's quite a list of benefits that applies to these investment zones. So that's interesting. This seems like, leveling up on steroids, basically. But it's, rather than going from the leveling up agenda, which was to put money into places that need it, these are more, we're not going to tax you, so you can keep your money and reinvest in yourselves. We'll see if that works, and I genuinely hope it does, but it doesn't seem likely, because normally when you don't tax people, they just keep it rather than do something with it. Green levies are not being followed through. The government's covering environmental and social costs of green levies. So basically, they're keeping the green levies in place, but then they're paying for them rather than repealing it, which seems a bit. So they're just giving more money to these energy companies. On the headlines, so where's the costs of it? Here we go. The growth plan tackling energy. I'll zoom in. Tackling energy price costs. So this is essentially the energy price guarantee, and that's the energy bill relief scheme. So this is essentially the energy bill relief scheme. the energy price cap is essentially a subsidy to energy producers because they're not allowed to charge residential people, normal people like me in my house. They're not allowed to charge us any more than a certain amount. This is the price cap per unit, I think it is. Yes, on a unit of electricity and gas, bringing average household bills to 2,500. Now, mine were 1,200 quid a year, sort of, more or less, last year. So that's more than double, which is, obviously not particularly good. But what they're going to do to keep that cap where it is that they're essentially going to subsidise the energy sector by the tune of not 31,000. This is in millions, so that's 31 billion pounds they're going to spend doing that, just giving that money away to these companies. The Energy Bill Relief Scheme. This is support for businesses just for 6 months. Just for 6 months. And this essentially means that again, it's a subsidy going out to energy companies, so they don't have to massively increase costs for businesses because businesses do not benefit from the price cap. So like your local chippy will have seen their energy bills shoot through the roof. Well, hopefully, the calculation is this allows the energy companies to bring those costs back down. So there are some that would argue that if these businesses, the energy sector, is unsustainable as a business model, then it probably should be nationalised because it is an item of national significance and national infrastructure. And there is an argument that privatisation hasn't worked. I'm not sure where I actually sit on that. I quite like there being options. But I can see, but I'm online and I shop around frequently, and I'm the sort of person that privatisation benefits. There are loads of people out there that it doesn't, so I can see both sides really. Personally, it works for me, but I understand why it's not working for other people, and certainly in circumstances like this, it's certainly not working. Now, the price cap was a again, cards on the table. I'm a proper centrist. I've voted for everybody. Over my, I'm 37, so I've had plenty of elections to vote for pretty much everybody, including a whole variety of independent candidates. I tend to read all the manifesto and just go for the one that seems to me will probably do the least amount of damage. That's my attitude. So just to clear that out of the way. Now, the price cap was a Labour idea, and the Tories rejected it at the time and then ended up having to do it. The windfall tax that Liz Truss says she disagrees with, they are doing it. It's here. Look, it's line 19 of this particular table. So this table here is essentially the financial impact of policy decisions. So along the top here, you've got the financial year. So this is April to April every year. And then you've got a list of all the changes and what they think the costs. So this one here, national insurance, reducing national insurance from November 22, that's going to cost, again, this is in millions, you can see here, so that's going to cost about £7 billion is what they reckon. And they're estimating that because of higher wages and profits, there will be more national insurance paid because people will pay themselves more. Again, that's a calculation. I mean, maybe that's right. So the net cost will be about 6 billion, they reckon, to scrap that national insurance. But they are still doing the energy profits levy here of 7.7 billion. So that's what they think they're going to reclaim. So they are doing. This is a windfall tax. Okay, this is a windfall tax. Now the energy companies have made tens of billions of pounds. Actually, more or less enough to pay for this. So the Conservatives are following through with Labour's plan. They're just not doing it to the extent that's actually effective. They're just kind of borrowing some and doing windfall tax for others. And they haven't changed Rishi Sunak's idea, which was basically, we'll charge a windfall tax unless that company then invests that money in sustainable, renewable, whatever. So, which to me, actually, I quite like that idea. If it is genuinely spare profit and you can't find a way to use it, then we'll take it and essentially subsidise bills to bail out the people of the UK. But if you do have a use for that that's going to make the energy sector in the UK much more resilient, and you can do that in the next year, great, crack on with that. So that to me makes a bit more sense. But personally, I think they could have gone a bit further with that. So that's the energy thing. That's the headline thing. I mean, there's lots and lots. There's a whole lot in this document. Really, there's a lot to read through. Now, because it's not a budget, a budget is automatically accompanied by a report from the Office for Budgetary Responsibility, which George Osborne created to essentially ensure that there's an independent body that will always oversee the implications of the budget and give an idea as to what the impact will be on growth. So, this is the growth plan. It is not a budget. There is no OBR assessment. The OBR were prepared to deliver their assessment, but the government chose not to allow the OBR to publish their assessment, which probably gives you an indication that the OBR think this is a dumb idea, and that projections it's not going to work. There is talk of trickle-down economics and supply-side theory and these sort of classical economic theories. The basic argument of trickle-down economics is if you tax the people at the top less, they will spend more money or invest in their businesses or whatever, and then the people at the bottom will have more, because that money will trickle down. Now, it's never worked and is unlikely to work again now. There doesn't seem to be a particularly nuanced or new framework that the government have come up with to get this to work. And as you saw with the pound, the markets don't agree with them. They think that's going to reduce stability in the UK. And talking about stability, here's another thing that's a bit worrying. 3.15 I've put here. What's 3.15? I've put 3.15 solvency. Ah, yes, bankers' bonuses. So bankers' bonuses used to be limited to 200% of their salary. So as Kwasi Kwarteng actually rightly pointed out, what that meant was that bankers' salaries were just increased. And because to allow the total package to be whatever that bank wanted to pay their banker. Now, are salaries going to reduce by getting rid of the banker's bonus? No, they're just going to pay higher bonuses. But so it's sort of accurate. The reason I think that they've allowed them to do that is because of this. So when they started consulting about scrapping EU rules from Solvency II, as soon as they started talking about that, the insurance companies said, oh yeah, we'd love that, because insurance companies have to hold lots of money in more or less dead assets to pay for, to essentially make sure that they've got enough money such that if a lot of claims come in, they'll be able to pay out all those claims. So if there's a massive flood, Aviva or other general insurance providers that are available can just pay out the buildings and contents claims, and then that's fine. Solvency II also applied to banks. Now, it's important to remember that Solvency II was brought in by the EU because of pressure that we were putting on the EU. Again, David Cameron and George Osborne, they brought in similar solvency style rules in the UK throughout like a series of stress testing UK banks over a period of time until I think it was about 2012, 2013 when resilience in the UK was pretty good. And then we started putting pressure on the EU and said, well, look, really, you should be doing this across the entire banking sector. So the EU then brought forward these rules about solvency. So these are a reaction to the 2008 global financial crisis, and more or less, they are there to stop something like that happening again. Banks are very well capitalised in the UK, and actually the reason that there are a lot of money is held in the UK is because we're so safe in terms of banking for the world. We're seen as a very safe place to hold money. Now, despite Brexit causing problems with trade and all the rest, people still see British banking as being quite safe. Solvency rules, scrapping those means that banking in the UK becomes less safe. And what that means is that people will be less trusting of British banks, just in general, because people depositing large sums of money are not going to bother to do any research about the capitalisation of the bank. It's too much work. You go to a British bank because it's safe. If Britain becomes less safe because we scrap a rule, fine, we'll just go to an American bank because they're a bit safer now. Or a Swiss bank, or a Dutch bank, or anybody complying with the solvency rules, and that is the EU. Any EU nation bank is, if these rules are scrapped, is automatically safer than a British bank in general. So, a Latvian bank is safer than Barclays because it complies with solvency rules. Bankers weren't really in favour of that. They thought that's going to lose us money. So I think the government then said, all right, well, what if we give you unlimited bonuses? And bankers went, now you mention it, I don't think it'll be that bad. So that sounds a bit conspiratorial, I know, but it just seems a bit kind of convenient. Really. Government is focused on delivering high quality regulation that supports economic growth. Growth from PRA will scrap poorly designed EU rules that limit variable pay. So this is, they are next door to each other in the document. It's like, we're going to do this 3.15, 3.16, 3.17. This is under a different heading. Okay. Again, I might be reading a bit too much into it, but it's almost as if this bit ended 3.15 and then they went on to the next section, but then they thought, we best add this in about the scrapping variable pay for senior bankers, which undermine growth and hinder financial stability. Hinder financial stability. How does putting a cap on bankers' bonuses hinder financial stability? That just doesn't make sense. Like, I don't. That seems to me a bit too convenient that they're next door to each other. So we've talked about energy. Go and watch my other video about inflation, because this isn't inflation. So inflation, just go and watch the other video for a longer explanation. But basically, inflation is where you increase the money in supply in an economy by a small amount every year, in order that prices go up in a sustainable fashion, just below your GDP growth, so you're getting some real GDP growth, but just so there's like a positive direction. And what that does is it forces people to spend their money now. If prices start to go down, then people hold off spending money. You end up with a depression, and that's very, very bad economically. That would, impoverish everybody if we ended up in that situation. So you want some level of inflation, but not. So this isn't inflation. This is a fundamental change of asset prices due to a huge shortage of gas due to, across the world, Russia, but in the UK there is an effect due to Brexit. Now, British inflation looks very similar to other countries' inflation because of Brexit. Actually, our inflation would be a lot lower were it not for that, because we don't really use gas very much in the UK. We use other ways to heat our homes. We're not massively reliant on gas from Russia. So I think it's something like 4% of our energy mix comes from Russian gas. So we're not really reliant on it. So inflation should be quite a lot lower than where it is. It's just that the general cost of importing everything has gone up since Johnson's deal was rushed through. Anyway, again, it's not Brexit per se. Brexit didn't have to be this way. It just was this way because of the deal that ended up being agreed and rushed through Parliament and voted on by both parties. And I still think that was Labour voting for the Brexit deal that Johnson signed was a terrible, terrible idea, and they should have opposed it because that's their job. But anyway, that's That's another thing. It's the job of the opposition to oppose. Who knew? This lot seem sometimes to, not really understand that. Anyway, so we've talked about pensions, we've talked about the economy, we've talked about tax. There are some little changes to tax that might benefit everybody a little bit. So they're reverting the national insurance rate back to that which it was in March. So you should see a little bit coming back into your pay packet. So it's actually 1.25% of your band earnings, so earnings between about 10 and 50 grand, that gets taxed to this specific banded rate. If you're on a low income, you'll see your money probably go down. They're increasing the eligibility criteria for universal credit, so some people who have it now won't get it. They're also faffing around with the taper rate and stuff like that to make work pay, it's kind of the opposite of what they're actually doing. But anyway, so people on relatively low incomes of between like 10 to 18,000 will probably see their earnings more or less the same because of faffing around with the universal credit, taking with one hand and national insurance giving with the other. And what else are they doing? Oh, yes, they're bringing forwards the income tax rate of 19% next year. So that, and again, I think they're only doing that to sort of spite Scotland, because Scotland have a 19% rate. That's their lowest rate of income tax, apart from the 0% rate, obviously. So I think they're just doing that to kind of say, well, we're lower tax than you, Nicola. It won't make that much difference for people. The big difference this year has been energy prices going up. Everybody's spending like at least £1,000 extra a year on energy. In some cases much more. Giving people, 100 and something quid on their income tax isn't going to cut it, because if you spent £1,000 and you're giving 100 quid, you're still 900 short. It's basic maths, really. But anyway, so when we come back to the markets and the market reaction, or the economic reaction, let's say, the Institute for Fiscal Studies has had a go at presenting an opinion. There he is. That's Kwasi Kwarteng. He was the one that, if you saw the funeral, he was the one that looked like he was a bit off his rocker on something. There's been a bit of speculation about, which is great news, isn't it? We just have some normal people in, but I don't think you ever get normal people in politics, do you? So the IFS have had a go at expressing an opinion on it. Now, they don't really know, and they haven't really had a massive amount of time to come up with this. But they see borrowing being over £110 billion a year, 4% of GDP, which is more than 80 billion higher than the 32. So the OBR in Rishi's budget in March said that we'll probably be borrowing £32 billion a year by 26-27. The IFS forecasts that it will be 80 billion higher than that. So the amount of national debt is just going to be astronomical. This £190 billion peak over the next year, that's 7.5% of national income. That's the third highest peak in borrowing since the Second World War, the global financial crisis, and the COVID-19. Sorry, the third highest. So 1, 2, 3. That doesn't make any sense. Which one's... There's 3 there, and this peak's the 4th, but they've said the 3rd. That doesn't make any sense. We can actually have a look ourselves, if I can quickly find borrowing, national borrowing, GDP, government. I think it's government spending, government debt. There we go. And then we need to find UK. There we are. And let's go max. Oh no, that's a total. I don't want a total. I want an annual. Government spending, that is a total. No government, but now I can't find it quickly. But anyway, it's a lot. Um, 40. So anyway, so there's a lot of they've said their forecast make no allowance for any top-up spending on public service spending. Basically, if an NHS trust overspends, then the government just have to find the money for it. They'll get told off. They might get put in special measures. The board might get sacked of that trust. However, the money's got to be found. They can't not spend the money on healthcare. So they're also not accounting to the most recent rise in gilt rates. Now, we saw what those are. That's pretty high. Gilt rates have gone up to the highest that they've. Where are we? Bond UK. So here we go. Nearly 4%. That's not the highest it's ever been. Actually, the highest it's ever been is probably about 1998, something like that. When they were around about 10%. So this is recently. So they have been hovering around 1%. That's okay. But that's not the highest. It's nowhere near the highest they've ever been. In fact, it was the 80s. Wow. I mean, okay, so it did peak in the 90s and it peaked again. I know it collapsed in 98. It did the opposite of what I thought. But I mean, we've not seen this level of the national debt costing as much for a significant period of time. Now, this is causing problems for lower risk investors. Actually, those people who have drawdown pensions, they're seeing values drop quite significantly, like 4 or 5% over the last month, fundamentally due to this, which is not good. So this is the OBR March forecast. So this was Rishi's budget. This is the light green. This is Kwasi Kwarteng's budget. There's a big difference. So this is underlying government. So essentially, the calculation or the stated calculation of the government is that essentially all of these tax measures will result in growth, and that means that essentially all of this will be paid for in growth. So the GDP will go. So the debt to GDP ratio will look better over time. There is something about growth in here somewhere, if I can find it. There's a lot of talk about stamp duty, land tax. Where's the growth stats? Have they actually done any growth stats? I thought they did, but that's net borrowing. No, they haven't talked about what they forecast economic growth to be. The OBR will have done, and I'd imagine the reason that it's not being published is because I don't think there will be any extra growth instigated. Yeah. Oh, this is another thing that I haven't talked about. So this is the last thing, the pensions charge cap. So the pensions charge cap was brought in 20... This is another pot of money that they think they're going to unleash, a bit like the solvency thing. If we scrap that bit of red tape, then all of this money will be free to be invested in the UK. Again, what are Aviva going to buy? Like, I mention Aviva again because they're sitting on piles of cash, and they're a big life insurance company. They're a big insurance company, just a general. But what are they going to do with the money? Where are they going to invest it? What's worth investing in the UK? I mean, they're not going to start piling money into private equity because, well, that's risky and dangerous. You want to. I know they did that before, but is there much appetite for that? Is there really any appetite for that? I'm not so certain. The pensions charge cap was brought in 2015, and essentially within a group pension, so like an employer scheme, charges were capped at 0.75%. The reason for that was that there were some very, very expensive group schemes where essentially people who didn't really have much say in where their pensions were invested didn't pay too much money. Sounds reasonable. Now the government are planning to scrap that because they think that what's the wording? Something like well-structured performance management fees will allow pension funds to start investing more in illiquid assets. There are dangers to investing in illiquid assets. Firstly, they're illiquid, which means you can't get at them in a hurry. And secondly, they are quite expensive to run. And so if the investment doesn't pay off, then you're going to end up with less money in the pot, which again, if these are for like master trust schemes and for big group schemes where there might only be 1, 2, 3 funds available because it's all set up to be like auto enrollment compliant, which is that thing where you have to pay into your pension more or less, or you pay in automatically. If this is applied to those schemes, then why should those people pay much more money? Because they've not really had much of a choice as to where the money gets invested. It's not like a private pension where you can pick an infrastructure fund if you want to, or you can pick something that trades in assets that are fairly illiquid. It's not a SIP. It's a group scheme where you might have the lifestyle balanced solution. Everybody goes into that. It doesn't seem to me to be sensible from an investment perspective. And in fact, there has been quite a bit of press coverage over the past few days in the tradies saying that, yeah, but it's not going to release much money because, well, those schemes know that they can't really do that because the people haven't really chosen for that to happen. So it doesn't seem, I'm not sure what this is designed to do, really. And I think that's my summary of the whole thing. I'm not entirely certain what the whole thing's designed to do. It just seems to be designed to give donors their donations back. Other than that, I'm not really certain what any of this is supposed to achieve. They say they're going for growth, but how are you going to get growth by taking money off poor people and giving it to rich people? That doesn't make sense. That's not how you get economic. I mean, loads of people have said this, but people who have low incomes, if you give them money, it all goes directly into the economy. That's how you get growth. It goes directly into the economy because they have to spend the money. They haven't got a choice. They will spend it on food and clothes and things that they haven't been buying because, well, they haven't got the money. If you give money to rich people, it ends up in savings accounts and it ends up in investment portfolios. And yes, it ends up being invested, but generally speaking, you buy listed stocks and they've already been listed. You're just buying assets that already exist. It's not creating money. It's not like there's going to be a slew of initial price offers where companies list and try to raise some capital to employ more people and generate growth. That's not what's happening. Rich people tend to talk to somebody like me and we end up investing it in a portfolio of stuff. It's not investment in terms of capital injection. It's investment in terms of, well, let's buy that thing that already exists and therefore the capital's not injected. It's just trading something. So I don't know what it's designed to achieve, and I genuinely don't think it's going to work. What should you be looking at within your portfolios? Well, I'm looking very closely at my gilt holdings in my advised business and trying to work out what to do with them. The problem is, if you look at other countries with low levels of inflation like Japan and Switzerland, Japan because the government's underwriting the cost of living, and Switzerland because the cost of living is already very expensive. So an increase of gas bills by $1,000. I mean, the cost of living is already very expensive in Switzerland, so that's not really made that much of a difference in percentage terms. But even Swiss debt has taken a tumble over the last, over the short term. I mean, we can see here. So even Swiss debt has taken a bit of a tumble recently, although it has. So basically, this is, if you want to look at the asset prices of bonds, it's the opposite to the yield. So as this goes up, the asset price comes down. So the yield used to be minus 1-ish, and now is 1 point. So that's 2.4%. coming off the value of the bond, sort of. So bonds have gone down in Switzerland by 2.5%. It's not as dramatic as the UK, but still, even countries that aren't going to have to increase their base rate are still seeing the value of debt come down. So it's where do you go? I mean, that's in terms of your low risk assets. Where do you go? I mean, I've had some people say, well, we should do crypto. Okay, I mean, you can, but it's hardly low risk. I mean, it was 66,000 each, and now it's 18,000 each. So it's lost about 70% over the last. And if we go back in time, well, it was worth, at one point, nothing really. It was worth like pence each, but it was worth $1,000. So it could go back to that price. I mean, that's only 2016 price. It's not that long ago. I mean, we're back to 2008 gilt prices, right? So if you can get a 14-year reversion over the course of a few months, you can quite happily get a 7-year price reversion over the same period of time. So you could see an asset. So that's not anywhere near safe, despite the fact that it doesn't really exist. Its value is not easy to explain. But, we'll see. Yeah. So over the next week, what's happening in the so this is an economic calendar that's on Trading Economics. I've got it set to be high impact news. There's some consumer confidence stuff. There's German consumer confidence coming in. The forecast is that it's going to be lower than it already exists. It is. Let's hope for a positive surprise there, but expect a negative surprise. It just looks like everything's still going quite badly. Inflation rate in it. I thought that was US personal income, personal spending. Yeah, that's not massively. Okay, so that's it really. So I've talked about the growth plan, or the mini budget 2022, which is not a mini budget. It's more or less a full budget, apart from the OBR scrutiny, the Office of Budget Responsibility scrutiny. And I think we probably know why there's not much scrutiny, but it's hopefully that's been helpful. Obviously, like, share, subscribe, do all those sorts of things. I'll play me outro in a second, and see you again soon.